Hello, on today's edition of The Final Bar, we'll talk about a lot of movement in stocks today with heavy earnings. We have financials on the move, healthcare on the move, a lot of stories to sort of unpack, themes to dig into. We're also going to look a little deeper at the healthcare sector, talk about some of the movers in terms of industries and individual names, also shifting stocks. And we're going to hear from my guest, Katie Stockton from Fairlead Strategies. Ladies and gentlemen, this is The Final Bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a continually snowy Redmond, Washington. Thanks for joining us here every weekday after the close to debrief on the movements in the markets, connect them to the longer-term trends, and get a proper long-term orientation to what we're seeing as these trends evolve and everything. I'm sure you probably have not followed too much of the weather here in the Seattle area, but it's been a brutal snowstorm. We're all sort of buried trying to dig out of this in a town where we're not used to getting snow. So I'm enjoying reliving some of my favorite New England nor'easters as I deal with the snow at home here. But thanks again for joining us on today's broadcast. Really appreciate it. You know, getting right to the market recap, I wanted to remind everyone before we do that, though, about all the different things we have coming up on the show in the coming weeks. And one actually just late edition that we put on was a special by Larry Williams called The Art of Forecasting. That's going to be broadcast tomorrow at 11:30 a.m. It's also going to be broadcast after this show at 4:30 p.m. Eastern tomorrow. Larry Williams is a contributor to StockCharts, does a fantastic job with his show, and he's going to share some of the pieces from his annual forecast. You're not going to want to miss that. Also tomorrow, I have Doug Bush from ChartSmarter, who's going to be joining me. Next week, we have Greg Schnell, the Canadian technician. Then on the 22nd, we have Greg Harmon. Also on the 22nd, we have the 2020 Market Outlook, where a number of my fellow StockCharts contributors are going to share our key charts for the 2020 calendar year. And then on January 29th, we will be unveiling our documentary broadcast, 50 Years on Wall Street with Ralph Acampora. So some fantastic programming, really proud of the StockCharts TV team. We're excited to bring some of these special broadcasts and also some of the wonderful guests that we're able to get in front of you. So make sure that you stay in tune for all of those. Let's get back to the market recap, though. So a lot of movement today, and as always, I feel like the world knows when we start prepping for this show because all the volatility seems to get injected immediately. And today was no different. We were sort of at the lows of the day before we rallied up a little bit going into the close. So even though today's bar looks like the final bar looks sort of like this nice gradual continuation to this uptrend that we've been seeing for the last couple months, I feel like today's trading day was anything but. This one price bar doesn't really bring to life all of the movements that you have. You have a lot of sectors, a lot of themes that are fluctuating. We're going to get to that next. But sticking with the big picture, just looking at this, it's a reminder that with all the movement in stocks, with all the earnings releases, with everything, the uptrend continues unabated. And again, as long as the stock market, the S&P 500, makes a pattern of higher highs and higher lows, by definition, the trend is positive. And by my read, you always want to be looking at the swing highs and swing lows, right? And it's sort of the extremes, the points that stick out on the chart. And this low around 32.10 is really the most recent swing low I'd be eyeing at this point. So as long as we remain above that in the short term, and that's still a pretty decent pullback over a couple of days, if we get down there, we're still okay. The uptrend still remains positive. So let's keep an eye on that. Also, again, as a reminder, this bearish divergence or this non-confirmation we've seen, sort of suggests we'll have some weakness, but we haven't seen it yet. So again, until you get a confirmation, some sort of downside move in stocks, the uptrend is in place. Let's look at the broad at the market, dig in a little deeper to some of the themes that we've seen. The S&P finished up about 0.2%. The small cap index up a little more, 0.38%. Mid caps about even with the S&P, up about 15 basis points. So overall, things finished in the green, but again, a lot of that it did not look that attractive a few moments ago, maybe 20 minutes ago, as markets were really selling off apparently into the close. If you look at the sector themes, you have utilities number one, followed by healthcare, followed by real estate. So even though the market finished in the green, you have things like utilities and real estate up at the top of the leadership list. Healthcare is an interesting one. You had United Healthcare with a big jump up, 10+%, I want to say. I didn't see exactly how it closed, but a pretty strong move during the day based on earnings. At the bottom, you have energy, which is no surprise. That's been pretty consistent. But you also have financials, and that divergence between the market and the financial sector, I think, is a really key theme to be thinking about going forward. Also interesting to note consumer staples versus consumer discretionary. So on an up day, you have this disagreement where the defensive side of consumers sort of leading the offensive side. So some really interesting sector themes. And again, when we get to the 3 and 3, well, I'll highlight for you some of the sector charts that I think are really important. And again, later in the show, we're going to do a sector deep dive here on the healthcare sector, dig into a little deeper into some of the themes that we're seeing. Worth noting on the the scooter movers, the stocks that are up the most today. You have some familiar names. I mentioned United Healthcare up pretty significantly. Sorry, it was 10 points, not 10%. Forgive me if I misspoke there. Up almost 3% here. Sold off a little bit going into the close, but overall holding up very, very nicely. ICE is another interesting chart in here that's in the financial sector, but it's part of that exchanges group, sort of market data group, which is a little different than a lot of the banks and regional banks, many of which sold off so aggressively. If you look at the right side, you'll see some of those regional bank themes that I mentioned, something like PNC, Zion, a number of names that BB&T that jump off the page as sort of weaker. You also see some of those energy stocks like MPC, like Valero, that are on there as well. So, sort of an energy financials sort of theme going on the downside. In terms of industry leadership, I also wanted to point out some of the industries that are looking incredibly strong. Home construction is one that jumps off, as well as gold miners. So again, that gold and gold stock trade is something that people ignore, I think, a lot of times, especially during a bull market phase. But it's interesting to note that these stocks actually had a pretty decent day. If a series of decent days turn into a decent trend, and then you really need to be aware of it. On the downside, actually, autos gave back a good amount. These have been on sort of the largest, biggest leaders list for a number of times. Almost on the bottom, you also had semiconductors with a pretty weak day, also banks. So those are some groups which I would argue, if you're more on the bullish side of the ledger, you would want to see groups like semiconductors, banks be holding up very, very nicely. We've not seen it. We've actually seen a little bit of a disagreement. So some interesting, even though the market, again, sort of sold off, but then finished up a little bit, you have some really interesting themes when you look a couple levels down at the sectors, at the industry. So we just touched on it here. I would encourage you to spend some more time with the member dashboard. Look at some of the movements in individual names. Look at some of the industries that are on the move, and look at the charts to really think about how they might be related and interrelated. It could give you some good ideas about where to be looking going forward. That's our market recap for today. We're going to move into a sector deep dive. This is one of the segments that I like to do because it focuses on sector rotation. And again, there are a lot of ways to think about sector rotation. We're going to start with the relative rotation graph, which my friend Julius de Kempener designed many years ago. I followed his work for a long time. Thrilled that he is part of the StockCharts contributors group and is doing some really good fine work on his blog and also on his show. So if you're not familiar with this methodology, check out Julius's work where you'll get a lot more color on it. But I think the healthcare sector in particular, I like to start by looking at how it compares to all the other sectors out here. So when I look at the RRG chart, I start with the weekly view, which is a way to, big picture, long-term, see how things are rotating relative to one another. And what we've seen here is a couple things. Number one, technology being long and strong to the right, heading northeast for the most part, sort of in a position of strength, and definitely out of all the sectors, the fact that it's furthest to the right means it's in the strongest relative position. But look at how healthcare is close second to that. So while financials have rotated lower now in the weakening quadrant, we're going to get to chart of the XLF later in the show today, healthcare has actually remained in a pretty strong place. I think healthcare in general is something we've not tended to think about because other sectors have been doing so well. Technology, and others have been holding up so well. Some of the big communication services names perhaps have been in such strong trends. If you're going to actually, healthcare across the board is starting to emerge as a pretty strong relative performer. And this chart shows you that it's been holding up very nicely. So if you look at healthcare and financials together, one of them has remained in a position of strength. Financials, on the other hand, has rotated to a position of weakness. We're seeing a lot of breakdowns in that sector in particular. Let's look at the sector chart of the XLV. So I tend to do the candle glance to get to those. What's interesting here is you can see over the last 2 years, the price has actually set up this beautiful sort of 12 to 18 month base, starting from last September, October, retesting that in the end of the year, but then again over the summer last year in July and August. And then look at how we broke above there in October of last year, retested it, and then continued stronger. So overall, you have this beautiful long-term base. The broader the base, the higher in space, and it suggests that there's very much upside in healthcare. The challenge maybe a little bit has been the relative strength. So if you look at this period, while this sector was basing out, you actually had a lot of other things that were doing very, very well. Calendar 2019, technology comes to mind, obviously, with semiconductors, Apple, others in strong relative uptrends. This was maybe hurt a little bit as it chopped around at the beginning of last year, but since then, it stabilized, and going into the fourth quarter, started to rally, started to go to new relative highs, and now we're potentially seeing a bit of a pullback before a reverse higher. And today's move is what made me think that this is a really decent time to look back at the charts of healthcare and think a little more deeply about it. So when we're looking at the healthcare sector and you want to do a deep dive in a sector, the next thing I like to do is look at the industry summary page. That's one of the tools. If you click on charts and tools, you'll see the sector summary and the industry summary. And if we scroll down to healthcare, you're going to see the 5 main groups that we use to break down the sector. And it's in order of the scooter ranking. So this is how this industry relates to all the other down industry indexes. So first, we have healthcare providers and pharmaceuticals. Sorry, I'm actually not sorting it the right way. My bad. Here we go. Healthcare providers, pharmaceuticals, number 1 and number 2. Then we have biotech, and we have medical equipment. So all 4 of those actually in a pretty decent place. Healthcare providers and pharmaceuticals have been the strongest. That's why their ranking is so high. It's a percentile ranking. Medical supplies has been the weakest of the 5. But as we're going to see in a moment, the charts are actually holding up very nicely for all 5 of these industry groups. So here I made a chart list with those 5 industries. I highlighted just some of the tickers that you might be familiar with, so you can understand how these all relate. So we're going to start with healthcare providers. This is the number 1 sector, and what you see on the chart of the healthcare providers is the resistance or the high at the beginning of December of last year. This is the market bottom Christmas Eve of last year. It didn't rally as much as other things, really sold off into April, and that's why on a relative basis, a lot of the underperformance, if not all of it, came in the first quarter of last year. Since then, sort of stabilized okay, put in a higher low here in October, which was pretty good, and then started to break to new highs and new lows. And this is driven by a number of stocks. United Healthcare was up big today, a couple percent on a sort of flat to up day, but you also have Healthcare of America, Anthem, Humana, other things that you might be familiar with. What's interesting here is it sort of rallied, hit a bit of choppiness, and now today sort of following through to the upside. Again, United Healthcare really driving that. What concerns me with this group is what concerns me on a lot of charts that have been up very well is you have this potential bearish divergence of higher highs, lower peaks in the RSI. So until you violate that, you have to be a little cautious of that group in particular. Pharmaceuticals have been fantastic. You don't see as much of a divergence because it's still in a position of strength. Here we have a bit of a tighter base, and you can see we broke above it last month in December of last year. Since then, has just continued, and this is driven by those big names that are big weights in the healthcare sector as well. Johnny John, Pfizer, Merck, CVS, Caremark are the 4 well-known names. This group is actually extremely overbought with an RSI above 80 again, which means even if you do get a bit of a pullback, the momentum is still very strong, also making a new potentially 5 or 6 month relative high this week. Biotechnology is another group, and I mentioned earlier, I think this is a really important one to watch because it's right at resistance, around 2,200 for this biotechnology index. The BTK is another one a lot of people follow. One of 2 things is going to happen with these big names. Either we're able to break above and follow through to the upside in a meaningful way, or we start to fail through the most recent swing low, fail through the 50-day. And I would argue whichever one of those you see, I think the broader market's most likely going to follow that sort of breakout. So this is relying on names like Biogen, Gilead, Amgen, AbbVie, and others you might be familiar with. The last 2 groups, just to round off this deep dive, are stocks that you may not be as familiar with, or maybe groups that you might not be following as much, because we tend to focus on the biggest names in the sector. But I think you're going to find that there's some really consistent uptrends here. So This medical equipment index has been outperforming the S&P, still up about 18% over the last 2 years. It's given back a good amount in the last couple months, but overall still holding up very nicely on an absolute basis, up good. This is Boston Scientific, Waters Corp, Medtronic, and so forth. And then finally, we have medical supplies. This is Baxter, Edwards Life Sciences, Becton Dickinson, Cardinal Health. This is almost a cup and handle pattern, sort of this complex basing pattern. And again, if we can get above this neckline, this resistance level, could mean a lot more upside. So I think what you'll see is all 5 of those healthcare groups actually look pretty good. None of them look bad. They just look really strong, like pharmaceuticals, to pretty strong right at a breakout level like this medical supplies group. But I would encourage you to keep a close eye on those 5 industries within healthcare, as well as some of those individual names that might be on the move. We're going to take a quick commercial break. We're going to be back with my guest, Katie Stockton from Fairlead Strategies. We'll see you in a minute.
I was staring at the north wall of my barn.
Okay.
And it's plain, it's boring, it's this whitish color. Mm-hmm. It's 70 feet long, it's about 18 feet high, and just blank. And I said to myself, 2017, I'm gonna be 50 years in the business. Wouldn't it be cool if I could just put the history of the stock market? That's where the idea came from. I wanted to capture my 50 years.
Hello, everyone, and welcome back to the show. I'm your host, Dave Keller with StockCharts.com. Thanks for joining us every weekday on The Final Bar. Please keep your questions and your feedback coming. You can get to us at The Final Bar at StockCharts.com. We love hearing from you. At this point, I want to welcome on my guest, Katie Stockton from Fairlead Strategies. Katie, it's such a pleasure to have you on the show.
Thanks for having me, Dave.
So I appreciate you sending a couple charts ahead of time. We've talked earlier in the show just about the S&P and this sort of consistent, unrelenting uptrend. The first chart you sent is looking at the S&P along with a number of support levels, including the cloud model. I'm curious what this is telling you.
Well, I mean, it feels like the market that doesn't look back. It's really been on a tear since that October low was established, and momentum has stayed positive from an intermediate and long-term perspective, and that's the big picture. That's, I think, within which the framework within which we look at these short-term indicators on the chart that you show here. We have the uptrend intact, pulled away from support, which I have drawn there right around 3150, based on a combination of a previous resistance level and also the 50-day moving average. So that would be a natural place for the S&P 500 to pull back to once you do get that meaningful loss of momentum. And I think that's not going to happen until you have something, and I don't know what it would be, hit sentiment. So market sentiment has just been incredibly bullish, and that at a certain point will become a contrarian reading for the markets, but it just hasn't happened yet. So once we get the sentiment readings pulling back, then I think we see a real impact on momentum here. The bottom window of this chart shows a MACD indicator, short-term momentum gauge. You can see it's faltered a little bit since the last push higher for the S&P 500, but really nothing too impactful to the chart, and that overbought condition is being sustained. So as long as that's sustained in the way that it has been, the market can maintain that uptrend. So we'd view a short-term pullback as just that, short-term, within the context of what is clearly a long-term uptrend. The cloud model really shows that pretty well. It's just a visual gauge of that trend and also a gauge of potential support, in this case with price well above it.
There was some fantastic investment wisdom hidden in your comments, Katie, which was great, which was the sentiment has been extreme, but essentially the trend is positive. So until you see some sort of reversal in the price, then the trend continues higher. The second chart that you sent is looking at the Qs, and obviously the technology leadership has been what a lot of people have been thinking about going into the first of the year. What is this telling you about tech and their position?
Well, here again, we can see the steep nature of the uptrend, which is disconcerting at times, of course, but the overbought condition based on the stochastic oscillator in the bottom window there has been maintained. When it falls back below that overbought reading of 80%, that's when we tend to get a meaningful enough loss of momentum to position for a pullback. There are some signs of short-term upside exhaustion. I have them highlighted there with the red arrows. They're based on the DeMark indicators to be specific. I'm sure you may have featured those over time on your show. But really importantly, it's an unconfirmed signal, and there's the projections from the breakout that we saw in 2019, really broadly speaking, so not just limited to the triple Qs. The targets are higher. So again, I want to contextualize any short-term commentary within that context with the measured move projection, or sort of assuming the trajectory of the current trend will maintain itself of above 230 for the triple Q. So if we did get a pullback, which I think ultimately we'll see develop in the next week or two, that to me would be an opportunity to take advantage of the breakouts that have already occurred and get a better risk reward ahead of that measured move projection.
These are two fantastic charts. We just have a little bit of time left, Katie, but the third chart I thought was really interesting. So many of us are focused on the strength in the U.S. markets. I think we've ignored global markets. You sent a chart of the relative of the IFA developed markets and also EM. What are you seeing here? What does this mean for looking at U.S. versus non-U.S. stocks here?
In the upper window there, you see the IFA countries are developed global versus the S&P 500 represented by the spiders. And you see new lows in the ratio. Obviously, a persistent long-term downtrend preceded that new low, and it really suggests that that downtrend is still very much in force, intact, and reflects U.S. outperformance, developed global underperformance. However, when you look at the same comparison for emerging markets versus the U.S. equity markets, you can see some stabilization in the ratio, meaning emerging markets have actually started to perform somewhat in line with the U.S. equity market, and that could be in part related to weakness that we've seen in the U.S. dollar. But it is something to make a note of as we get into a new year here, something that could be a shift unfolding, something counter trend at least to take advantage of. So we're keeping an eye on these ratios as a way to determine some intermediate term asset allocation decisions.
Katie, those are three fantastic, beautiful charts. Thank you so much for joining us today. We really, really appreciate it.
Of course.
That was Katie Stockton from Fairlead Strategies. Three fantastic charts, and she is the type of analyst that the people managing lots of money tend to listen to. So pleasure to have her on the show. I did want to move on to our next segment, shifting stocks. So what I wanted to do, this is a segment where we love to just highlight some of the sectors and groups and themes that are on the move. I wanted to focus just very briefly on financials, and in particular, some of the movements that we've seen in the financial sector this week. So it's a big earnings week, right? So you've got all sorts of companies starting to report and in the financial sector, and that's causing a lot of movements, a lot of relative movements. The XLF, if you look on a price basis, doesn't look too bad. And one of the reasons why I always hammer home the importance of relative charts is because on an absolute basis, even though the sector's holding up fine, the XLF is holding above around 30.50, which is pretty decent. Look at the relative strength, though. In the last 6 weeks, you've had this real rotation from a consistent outperformance from August to December to now a period of underperformance where the relative line is sloping down. And that's because so many stocks like tech, healthcare, others are breaking to new highs, holding at new highs, while the XLF is just stabilizing. So even though you're okay on an absolute basis, you're really not getting paid to own the sector right now. Let's look at some of the themes within there. And in particular, I wanted to look at regional banks, because if you look at the list of stocks on the move today, a lot of the ones on the negative side, the biggest scooter losers today, were regional banks, things like Key and BB&T and other names that you may be familiar with. So what's happened here with the regional bank index, this is KRE, it's a regional bank ETF. You've had this stepwise motion and overall holding up in that it has a similar pattern of an impulse move up and then a correction back, an impulse move up, a corrective move back, and that pattern potentially is continuing. I think the real key is where we're at right now with the RSI. So in a cyclical bull trend, in a bullish phase, The RSI doesn't tend to get below 40 because that's where it tends to be a decent pullback within a stronger uptrend. That's what that tends to, how it tends to play out. What concerns me with the regional bank ETF, though, is as of today, we're now breaking down through the most recent swing low. So all of a sudden, it feels more like we're having a lower low here. We're also breaking down through the 50-day moving average. So I think it's at a very key point right now. Again, with the RSI almost down to 40, this is either the time when this becomes a very viable move and this pattern, this uptrend continues, or we continue to break down, we see inherent weakness. And based on what I've seen on a relative basis, I have a feeling it's going to be more of the latter. It's going to be more of a relative weakness sort of situation. Again, I'm looking at the RSI on this to see if it remains at or above 40. But at this point, I don't like the fact that we're breaking to new swing lows. Let's look at some of the stocks that are on the list here very quickly. And we can see on the downside something like Zion, Z-I-O-N. You can see that this is broken down. Again, a lot of these charts are going to look very similar to the regional bank ETF. This was down 2% today, down through the 50-day. Relative strength making a new 13-week low, which is not what I want to see. I want to see the opposite. We have PNC with a heavy move down, again, breaking down through the 50-day. The RSI just getting below 40, so I think it's very key. Also breaking down on a relative basis. One other, we had Key on here. I don't know if, yep, number 10. Key also, maybe the worst of the four in that it's now bounced off the 50-day and now broken down through it. But you can see this consistent pattern, the relative breakdown, the price breakdown of support and the 50-day moving average and RSI at or just below 40. So I think this group and the movers that you see within the financial sector are really key. Also remember, you have stocks like JP Morgan, Goldman Sachs, others, big movers. I think the sector is really interesting to look into, but in general, overall, weaker rather than stronger. We, folks, need to wrap up the show by going to the 3 in 3. So at the end of every broadcast, 3 charts in 3 minutes, and let's get right to them. So number one, I sort of hinted earlier, there's a sector theme to what we're going to talk about here in the 3 in 3. And I wanted to start with the XLY, consumer discretionary, versus XLP, consumer staples. We've looked at this chart a number of times before, and you saw this downtrend in the ratio as staples were outperforming. You then started to see this reversal higher, and it broke above trendline resistance here as you saw the ratio go above. But on an equal weighted basis, you never really broke out. It sort of stabilized here. Now we start to see the ratio breaking down a little bit. We talked at the beginning of the broadcast about staples being up while discretionary was down today, and that's why this ratio has continued lower really over the last week. So now we're potentially breaking down, getting a new relative low in that ratio, suggesting a flight more to the defensive side of consumer. We talked about financials, and again, I think this chart is a really interesting one to watch with a lot of sectors, a lot of, the broad market. Katie Stockton, my guest, was talking about, an interim low in the S&P and where you might expect support. I think with something like the XLF and others, you have sort of this demand area, this area between the most recent swing low and the 50-day moving average. They're all pretty tightly related. If we're able to hold those levels, the market overall is going to do okay. But if we start to get something like the XLF break down, and again, maybe regional banks, what we're seeing there is a precursor to what we're going to see with the broader XLF, that tells you about weakness underneath the hood. And I think the relative breakdown is what's most concerning, with the XLF teasing a new 13-week low in the relative strength. On the upside, we did a deep dive in the healthcare sector, looking at the 5 different industry groups and how to think of those. I definitely point out the XLV as a sector I think that is emerging as real leadership. This has the benefits of potential upside from things like biotech, more speculative, but also being more of a defensive sector at times. And there could certainly be a scenario where the market struggles, but something like healthcare just holds up beautifully and all of a sudden emerges as a strong relative performer. So if you're not looking at those 2 sectors, the XLF financials, the XLV healthcare, I'd encourage you to start with the sector charts and then go deeper into the industries and some of the bigger names in there. Use the Scooter reports as a way to understand how all those different sectors are related. And ladies and gentlemen, that is our show for today. Thanks so much for joining us today and every weekday after the close to look at the charts, the short-term and long-term charts. I want to remind you to get your questions and your feedback coming to the final bar at StockCharts.com, or put them in the Q&A during the show, and we'll be happy to answer them. All of our previous shows are on our YouTube channel for Stock Charts, so please check those out if you missed any of the broadcasts. I want a special thank you to my guest, Katie Stockton from Fairlead Strategies. Ladies and gentlemen, for Stock Charts in a snowy Redmond, Washington, this is Dave Keller. Have a great night.